folks, Dan Frio here. Today we're meeting, if you haven't ever seen this guy before, then you're hiding under a rock. The ninja, the man. So,
hey everybody.
So here's what happened. My whole goal on my channel is if you're subscribing to my channel and you view my channel, is I just want to provide the facts and the truth to all you guys. So I reach out to the doom and crash brothers all day long, and most of them, I'll say all of them other than this one, they won't have me. They won't interview me. They won't do anything because all they do is push the world's crashing, the world's crashing, the world's crashing, and they get these videos. Yeah. And they get you to watch these videos. Yeah. You were one of the only people that ever got back with me and said, yeah, I'd love to. And actually, we're in Chicago. Yeah. We're in Chicago right now. He's from Southern California. He's in town, and we met. And we're actually having some cocktails. God bless you, brother.
Thank you.
So what we wanted to do today and share with you guys is the debate. We'll call it the big debate. I know the presidential election's coming up this year, but let's talk the debate on, is the housing market going to crash? Or is it going to be smooth sailing from here on out? So that's what we're really going to discuss today. The whys behind all this, because you guys know, I want you to know the whys behind everything. So I can't thank you enough, bud, for joining me.
No, this is awesome.
This is so cool. When you responded on one of my videos and said, hey, I got an idea. Yeah. I was like, okay, you got to be shitting me here. So because I've had one other guy, you know him, and I think your names are kind of similar.
Sort of.
He was trying to catfish me. And I don't know if they were texting me and doing some things, trying to bait me into some things, and it didn't work. But these guys they do what they do, and it drives me nuts. So I guess you had the cojones enough to come in and say, okay, Dan, let's talk. So I greatly appreciate it, man.
Thank you so much. So first off, I am a crash guy, right? Yeah, yes, and let's just lay this out. Doom and gloom sells.
Yeah.
Okay? Not a lot of people want to tell you that, but it's true. But the sad thing is, when I was very bullish about real estate back in 2001, I was the crazy person. It was because I was the bullish person during the right season, the right time in the cycle. All right, now we're sitting during a collapse. And it's hard for a lot of people to understand because they don't see or understand what the feeling is, the emotions tied to when a collapse starts. They usually tie collapse to when the media tells them, like when Lehman Brothers collapsed. Lehman Brothers shut down, they're done. Okay, we're in crash. Or when the government announces an official recession. Oh, okay, we're obviously recessioned. You blame the drink, but I talk like this normally live. I'm so bad with the words. But my point being is that when things pull back, people go, oh, the official narrative says we're pulling back, and so we must be pulling back, so I'm going to spend less. Yeah. All right. So a lot of very smart, intelligent investors, people that are patient, people that are quiet. That's why my channel is called The Ninja, because ninjas seem to do things quietly, secretly. They think more than they act on. And we start to see the signs of a crash as things go from bad to worse. So we've been in a time where our country, our world is propped up by insane spending. Yeah. And the last time we saw insane spending was actually after the official narrative announced we were in a crash, when Lehman Brothers crashed, right? That's when we saw quantitative easing, we saw interest rates drop. And what most people don't realize, yet they're begging for interest rates to drop right now, is that interest rates only drop when things get really scary.
Bad.
Yeah, like after 9/11 and after the dot-com crash. Yeah. That's when the Federal Reserve goes, we have to stimulate the economy, so we're going to dive rates lower. Everyone in 2005 to 2007 was begging for lower rates. One rate hike cycle that actually went very underreported was the one from 2015 to 2018. Fed started raising rates. They took them from about 25 basis points to 225, 250 basis points. And that was when the president at the time started screaming and yelling, going, the Fed's trying to crash the markets. And what most people don't realize is that they were. You see, the Federal Reserve runs rates low and they run rates high. Now, in the last 24, 25 years, we have had the lowest interest rates in the history of our country. That should tell you something.
Yeah.
The other thing that's really scary is that people always believe that homes only go up in value because they always love to look at those 30, 40-year charts, 50-year charts. And that's because the Federal Reserve is hell-bent on destroying the purchasing power of your currency every year at a minimum of 2%. Now, the reason why it's 2% is because 2% is super easy to not notice. You just sort of accept it. It's like that frog in the boiling pot of water, right?
Yeah,
If you
right.
if you turn it up slowly, it's like, it's warm. And it's like, wow, now we're in a hot tub,
Holy shit.
Yeah, until you're like, man, I'm sweating. And then all of a sudden you're screwed. So the point being is that is exactly what happens with inflation. So my point is that there's a lot of YouTubers out there that want to use and abuse other YouTubers, mainstream media people, or anybody they can get their hands on, and they understand that doom sells. Well, the thing is, the craziest my channel's ever going to get is when I say it's time to buy homes. And that is going to be when the Fed finally pivots for real, because I do believe they're about to do a head fake, which they've done 4 times since 1972, right before an election, where they drop rates. When rates go up because of inflation, you'll see them drop rates about, on a percentage basis, equal to about 10 or 15% of the first rate hike cycle. Then it jumps an additional 50% at minimum from the first rise. It's a mathematical equation. Anyway, without boring people, we're going to see rates dip a little bit on the Fed side. It's probably not going to affect mortgage rates because the bond market's imploding. Right? We have less countries around the world that are wanting to buy our bonds. So since we have less buyers of bonds, the government and corporations have to ask or offer higher interest rates. So we have rates going up completely opposite of what the Federal Reserve is doing. It's actually the first time this has happened since the early 80s. And so what we're going to see is much higher rates, even if we have a Fed fake out right before the election, because the Fed wants a special type of president. Because most people don't understand the Federal Reserve is a private bank. They have a charter. They have to be authorized to do what they're doing. The Treasury ultimately signs off on what they're doing, but what people don't realize is that the Federal Reserve wants the government to borrow money because they print it out of nothing. Zero.
Right.
And then they get all of that back plus interest. So they want a constant velocity of money. Their job is to get the public to understand or not understand the relationship of the velocity of money to the cost of money. And that's what we're seeing right now. We're seeing actually the velocity of money picking up and the cost of money picking up until the velocity slows down. So when both of those rise, we have inflation. So I'm probably getting a little too much.
No,
into things,
so you guys on the channel, everything he was saying, we've talked about on the channel. Why rates are going up, why bond. The bond market's completely disconnected.
Yeah.
So here's one of the questions I want to ask you, because this is going through history. Everybody asks me every day, what are mortgage rates going to do?
Yep.
So, if you go back through history, it's usually, when I first got into businesses, you watch the 10-year Treasury.
Yeah.
And then you add a spread to the 10-year Treasury, and that's what mortgage rates would be.
Yep.
Nobody really understood the MBS markets and things like that.
Oh, yeah.
So the MBS market always had basically the spread between, the 10-year Treasury and mortgage rates were about 150 to 170 basis points.
Yeah.
Right now, what's the 10-year Treasury is at almost close to 5 now, but 4.6, 4.7. But you have rates at 7.5.
Yep.
So the spread is huge.
Yeah, because of prime. Yeah. So the story you're talking about with MBS, it's fresh in a lot of consumers' minds because of what happened in 2008. What people really need to understand is what's going on in CMBS. Commercial mortgage-backed securities make up what the bubble that has been blown up in commercial mortgage-backed securities by regional banks, mid-size, large banks, but not like the largest, is much worse than MBS. Okay, and what's scary about CMBS is the rate at which they have to be refinanced.
Right.
If you couple what happened with COVID and with everything shutting down and people figuring out, oh my gosh, I could do work over Zoom. This is excellent. I can mow lawns and drink cocktails at the same time, and make money. The need for office space diminished. Okay, so corporate America is rapidly changing. That timed with how cheap those CMBS assets were priced at or valued at based on the debt amount that was underwritten and the income coming in. Now you take that and you move forward and go, well, wait, we're in a higher interest rate environment. They have to all be refinanced, right? Because the normal cycle on a large CMBS is like, what, 5 years?
5 years,
yeah. Amortized over longer, but 5 years they have to be refinanced. We got ourselves a serious problem. Mm-hmm. And so now, in 2023, it's already done. We've had more dollars lost in a banking crisis in 2023 than we had in all of 2008. And what's scary is in July, the FDIC came out and said, we are insolvent. We have no money left. And it went very underreported. Now, this is what's really exciting. FDIC says we're insolvent by July. In September, they say we need the big banks to cough up more money because the Federal Reserve said for insurance, the FDIC says that. Fed goes, well, we can't let the small and mid-sized banks pay the extra insurance costs for the FDIC insurance amount for deposits. And so we'll put it on the big banks. A month later, you've got, October, November, you've got the JP Morgan, Wells Fargo, Citibank, Bank of America CEOs sitting in front of the Senate saying, you can't put this on us. Like between the FDIC insurance costs that are going up and now under new Basel requirements, the additional amount that we have to hold back in reserves, I think it's like a total of 3%. Crazy. Yeah, going back to that because most people don't realize COVID, they just said, okay, no reserve requirements. Like you don't need to hold anybody's money in a separate savings account for an emergency, which used to be 3%. Well, between the added FDIC numbers and the extra, insurance amounts and all that stuff, the reserve requirements, they said we can't compete with world banks. So at that point, you've got to look at yourself in the mirror and go, okay, these are the facts that I'm seeing on the news. It doesn't seem like the banks are solvent. Is there a problem? Well, just like 2008, I was selling my property in 2005, 2006, because that's when the actual crisis happened. MBS fell apart in 2005. Ben Bernanke went to the nation and said on an address on CNBC that they've stemmed the tide, they fixed everything. In 2005, he didn't. And that was the first earthquake, and then you had these ripples go out, these aftershocks that destroyed the financial system. And so right now, we've already seen the first collapse, which was 2023 in the banking system. Now,
so what do you mean by that?
Yeah.
The collapse.
Yeah, so in November of 2022, I came out and said after the FTX scandal came through, I said, you're going to see the banks start to collapse in the first or second quarter of 2023. The reason why I know this is it's not going to be attached to cryptocurrency. It's going to be attached to derivatives that start firing off, and one or two banks are going to fail, and then it's going to lead to the opening of all these other banks failing. So the first bank that failed was based off of Bitcoin's crash and FTX's crash, and it was Silvergate La Jolla. Silvergate La Jolla, this is a really exciting story.
I heard the Silicon Valley Bank. So actually, I know a guy that's a bond trader.
Yeah, so the reason why SVB went down is because of Silvergate La Jolla.
Okay.
See, because all of these banks have an incestuous relationship, right? And they all feed off of each other. They lend each other money. When one of them goes down, a small one, it always has that ripple effect. When you drop, it's funny. It's the same frequency as dropping a pebble in calm water.
Like a piece of ice in there.
Exactly. Great point. So you drop a pebble in perfectly calm water. Think about it. The first ripples come out. They're like this big, and they're tall, right? But then as they go out, for a certain point, the frequency actually gets more powerful. The wave pattern gets shorter, but it gets deeper and wider and more round. And so for a certain point, that frequency actually goes out, like if you had a spectrometer. Anyway, sorry, this is like 8th grade science, but as it goes out, it starts to get more powerful and then it dies down. Well, it's the same thing with economics. Economic booms and busts are all built off of one thing and one thing only: human emotions. Human emotions are what drove the .com boom, the bust. It drove the real estate boom and bust. I started in 2001 in real estate. I started in 1998 in stocks. And both those times I sold a majority of my portfolios before the crash, because I started to see and feel that frequency, that change, that shift in the environment. Well, now we have that shift, but it's so massive. It is actually a cycle that dates all the way back to 1918 and the Spanish flu, which actually caused the Depression of 1920, which actually caused the Federal Reserve to print too much money, goes through the Roaring '20s, the crash of '29. You could see the exact same parallels, but on a different calendar, not the Gregorian calendar, but the Jewish calendar, you could see the exact cycle play out. And it's crazy when you just shift your mind and the way you look at things, you start to see the big picture. Well, that's why a lot of people don't want to come on your channel, because they don't have the ability to explain this.
I was just going to say that. I'm like, when I try to talk to a lot of the Crash brothers, and you guys know I bash people every day and I get pounded, was they don't, their whole concept of this is it's going to crash because it crashed in 2008. In 2008, the houses ran up so fast in price
Yeah.
that they had to crash. So now we have the same thing happening now. They went up so much in price, they have to crash. And I'm like, that's not how this works. But there's more to the story, and you get it.
Yeah, let me explain why this one is different than 2008, because people don't understand this. So before 2008, as it was collapsing, the government did not intervene.
Right.
Okay. So this time, in the last, we just had a report come out that $1 trillion was printed in the last 100 days. And that report came out 90 days ago. Okay. I did a video that said within a year and a half, you will see the government print $1 trillion a month. All right. The more money printed by the government, authorized by the government, the Federal Reserve prints it, the government authorizes it, which means the government owes it back with interest. That's mine and your
Sure,
taxpayer dollars. What happens is that as that goes out, it's a little Band-Aid. So you see the president come out and float out ideas. Hey, let's solve some people's debt problems. We're gonna sprinkle some money over here. They don't do it. He just promises it because he's trying to get elected. But then they promise little pockets of. I know someone that makes $600,000 a year, and they qualified to have all of their student debt paid off. Just because it was a special system because of where they were born, what their nationality was, and what kind of industry they're in. Okay, so this money is actually getting spent on it's called salting, right? You just salt the peasants with a little bit of something, a little love, and then they get excited. Well, that actually, and the Federal Reserve does this every once in a while, they get you thinking, like Jerome Powell said, we're gonna pencil in 3 rate cuts. Everyone got excited throughout the market's rally. That's the first shot across the bow. That's a verbal. Just get all the quants and the bot traders to trade up the market. He said penciled. If you understand wordsmithing, that means there's an eraser attached to that. So, and they always say we're data dependent, right?
Right.
So the difference between this crash and the 2008 crash, which makes this one so much worse, is they're actually printing money as the markets are crashing to make you believe everything's okay. But the truth is, every single person watching this video can go back to their gas receipt in their car or truck, go to their grocery bill and say, wait a minute, I'm not making more money. Now, sure, who's getting paid more? The lowest paid people in the country, they're getting more. The fast food workers in California. The people that don't make the most amount of money, they're getting thrown a 10 or 15, 20% bone. And the reason why is because, true, there's more people in poverty and more people in the lower middle class than there are in the middle class and the upper middle class, right? And that's who you need to salt right before a election. Then afterwards, what's to lose?
Screw them until
Exactly.
the next go 3 years and then start your promises all over again.
Yeah, and a wealthy person understands these cycles because I run into them all the time. And we're not talking like just rich people, right? They get it. And they go, we're going to make so much more money on the back end. It's like BlackRock. I said BlackRock's going to crash one day. Everyone freaked out. So BlackRock runs all their money on debt. All of the money they make is based off of debt, but also it's off of your pension money, my pension money, the 401k money. All of that money is what they're using to buy up assets and turn us into renters. So it's a really big deal to understand why this crash is different. This crash is going to move us into a slight bout of hyperinflation, and there's 2 waves of inflation. We already finished wave 1. It dipped, and now we're about to explode higher. And that's what's really going to be sad if we can't wake up enough people in this country to start to become wealthy. And that's why gold's going up, silver, Bitcoin, all these things, because people are now grasping at straws because they're chasing yield. And what most people don't understand is during every inflation or hyperinflation, stock markets always act accordingly or react. And the reason why I say that is because what people do is they chase yield. They go, my livelihood, if I have one, if I have a job, because the Fed wants higher unemployment.
Sure.
They need to grab money out of the bank, borrow money out of their house, and try and gamble it in the stock market, gamble it in bond markets, gamble it in cryptocurrency markets, even before those existed, because they're trying to chase yield to get as much money back to live.
Sure, yeah.
And in Venezuela, you'd have, let's say, 10,000% hyperinflation, and everyone was freaking out going, dude, the Venezuelan stock market's up 8,000%. Well, it doesn't matter because 10,000%, you're still losing money. In a heavy inflationary to hyperinflationary scenario, stock market never keeps up, but it looks like it is.
Got it. What's your take on the student loan forgiveness?
It's a political move,
Okay.
100%. And that's the thing. And I have to be honest. I tell everyone that listens to me, I said, if you qualify, you go for it.
Right.
You go for it now. Because if you're watching my channel, you're a different type of human being. And so a dollar saved is a dollar earned. So if you don't got to pay that loan back, gosh darn, you go get that thing forgiven, and then I want you buying gold, silver, paying off debt.
It
End of
still
story.
pisses me off because it's like,
Oh, yeah.
you see everybody. So what are they going to do with the people in the past that paid all this debt, the student loan
They're
debt?
going to incite a civil war.
Yeah, and then you're not curing the cause.
Yep.
It's like all you're doing is saying, okay, the colleges got their money.
Yeah.
The students, I mean, they were supposed to get an education and then after that get a job.
Yeah.
But it's not my fault that they didn't get a job.
So it's class warfare.
Yeah.
If you think about it, you work at a company and you have all of the hard-working people. It's like Caltrans, right? You got one guy shoveling and four guys looking
Yeah.
at him, standing on the shovels. And so it incites that kind of situation, right? What people need to understand is there's two different types of forgiveness. There's the real forgiveness where someone can apply and get a certain percentage of their loan knocked off. I'm all for that. If you're going to throw money out, fine, whatever. Just make it equal amongst all human beings.
Everybody.
Say everybody
Or go
gets
to the colleges
5% knocked off.
and have them, like they did with our commissions and everything else, cap the stuff.
Yeah.
You can't go up a certain percentage. But okay, now let's get to the nitty gritty. This might be take 2 after this one.